Monday, August 18th. Welcome to MarketFoolery. I'm Chris Hill. Joining me in studio today from Motley Fool 1, Jason Moser. Thanks for being here, man.
Yes, sir.
As I mentioned on Thursday's MarketFoolery, I'm not here this week. This is pre-recorded.
I'm confused now. What's today?
For folks listening, it's Monday, August 18th.
We're just going to go with that.
You and I are taping this a little bit earlier, but all week we're going to be talking about different topics around investing. And this is something you and I have talked about outside the studio, and that is, how do you get people involved in investing? Because it's what we do for a living. The people listening are involved, but all of us have people in our lives that we look at and we think, gosh, we got to get you involved in this just a little bit more, whether it's kids or friends, other people in our family. We got a great email from a listener that touches on this, but I'm just regardless of who it is, and you know what, we'll get to kids in a moment, but let's start with adults. How do you get people involved in investing? Because, and we talked about this right before we started taping, a lot of people out there look at the market and think it's completely rigged.
Yeah.
And a lot of people have been conditioned to think that investing is every bit as challenging as rocket science, and therefore it's like, well, I'm not smart enough to do it. And you combine those two things, that's a very powerful force to keep people away from investing.
Well, it really is, and I mean, it makes the option of just taking no action at all seem like, just the easiest and most sensible thing to do. I mean, I think, the general skepticism, I think that's got to be the biggest hurdle we need to overcome today, in particularly with adults. I mean, as we get older, we get a little bit more set in our ways, and we're a little bit tougher to sway one way or the other. And I mean, I'll just draw a comparison there. I mean, many of you know out there that I was a PJ Club professional for a number of years before I, fell into this job, thankfully. But I taught a lot of golf, and invariably, anytime I was teaching an adult, most of these people I taught were older than I am. They number one, they didn't really want to hear it coming from someone who was just basically a kid, and they were just always really set in there. It was very difficult to get them to change, even just the smallest thing in their golf game. And it was that classic short-term versus long-term perspective. We got to take a little bit of the pain here in the short run to really achieve that long-term success. And so that was a big hurdle to overcome there. And I think we see the same things when it comes to investing and teaching adults how to invest. I mean, I was very lucky growing up. My dad, he's a physician by trade, but he is also an investor, and he taught me all about investing as I grew up. And so I was lucky that my dad handed me that gift at a young age, and it stuck. And it's why I'm so active in teaching my kids as well. But I think that with adults, one of the things that it's unbelievable to me, the amount of press out there that would lead you to believe the market is a rigged game. And I think it was Michael Lewis who came out with that recent book, Flash Boys. Mm-hmm. And I even think he was out there, calling the market rigged to an extent. And I totally disagree with that. I mean, I think, to me, the market and investing is your best bet in taking control of your own financial destiny and being able to do what you want to do in life. And that's what we have to do, is work on teaching people that, number one, it's not a rigged game. But number two, there are plenty of options out there. It's not like you have to buy just individual stocks. I mean, one of the things we tell people all the time is, you just have to participate, and that could be, taking part of your employees or your employer's 401k. That could be, investing in just an S&P 500 index fund that gives you broad exposure to all of those companies and really, gives you instant diversity, and then just doing it on a constant basis. But the older we get, the more we want to see instant results, and you combine the desire for those instant results with a genuine skepticism, I think, and it just becomes a very powerful hurdle that we have to overcome. And those are the two key points, I think, that we continue to try to address.
Well, and a lot of people just don't want to do it, and so for them, to your point, an S&P 500 index fund makes perfect sense, particularly if it's, the lower the fees, the better. Mm-hmm. But I think for a lot of people, just connecting whatever they are naturally interested in, because if you look at investing and say, well, I'm not interested in investing, it's like, okay, well, what are you interested in? Because chances are, whatever you're interested in, there are multiple public companies that operate in that space. And for some people, it's technology. For some people, it's sports. You know, I like sports. Well, great. You know, Under Armour, Nike, Dick's Sporting Goods, Sports Authority. You know, there are all these companies that are publicly traded. So I think being able to tie into that.
Oh yeah, I mean, there's no question about it. I mean, I think that's an excellent point. I mean, it's one that I'll go back again to my father when I was growing up. I mean, he took an interest in some of sort of the medical field, the related stocks there, and because that was his scope of knowledge. He knew that stuff and he used it to his advantage. Not to his advantage illegally, obviously,
Right.
but I mean that's the point though, is that there is just this huge world of investments, of opportunities out there, companies that are doing all sorts of different things. And yeah, I mean, I guarantee you that whatever you're interested in, no matter who you are, I'm certain we can tie an investing angle to it. And I think that's part of the fun, really, is figuring out that investing angle, and then learning to look at it, to assess it, to analyze it, to see, well, there's Under Armour and there's Nike and there's Dick's Sporting Goods and there's Sports Authority. Are they all publicly traded? No, Sports Authority is a private company. Okay, well, so you have 3 or 4 opportunities there. Are they all the same? No. How do they differ? And who competes with whom, and how do they rely on each other? And it's just it's interesting to study that stuff. I think you certainly learn a lot more about just business in general, and so I think we enjoy kind of nerding out on that stuff. I get not everybody's going to want to do that, but if you are interested in things like that, I think that certainly gives you another reason to consider looking into it.
Got an email from Sam Waterbury, who writes, "My little brother recently graduated from high school and will be heading to college soon. Rather than just giving him some cash, I thought it would be nice to talk with him about the stock market and buy stocks in a few companies he's interested in, with the understanding that he would not be able to touch them for at least 4 years and that his gift would grow over that timeline. I know you can't recommend individual stocks, but do you have any suggestions for ways to get him excited about investing and thinking about a longer timeline than the Xbox refresh cycle?" Great question. First of all, I love this idea.
I do too.
I just love that it's like, we're going to buy these, we're going to talk about these from time to time, and you cannot touch them for 4 years, which for someone who's 18 years old, that's perfect. And it ties into something that Tom Gardner, our CEO, talks about all the time, that the single best step an individual owner of stocks can take to increase their returns is to just simply double your time horizon.
Yeah.
And particularly when it's just everything is week to week, quarter to quarter, all of us going in with the mindset of these are untouchable for 4 years. I think that's fantastic.
Yeah, I love that idea, and it reminds me that's an awesome idea. First and foremost, I mean, I can't applaud that enough. A while back, I had the good fortune to speak with Secretary of Education Arnie Duncan, about financial literacy, and one of the ideas that I had, I still think this is a great idea. I hope that one day we see it implemented in our in our schools everywhere. But I think it would just be cool if incoming freshmen in high school, you take a semester-long course on finance that gears you around investing to some degree, and this could be something that we could even help with, to that extent. But then, the end of the semester, you have to pick 5 companies, maybe it's 10, 5 or 10, whatever, to build out a portfolio. Companies that you're interested, whatever, and then that portfolio sits for the next 3.5 years until you graduate. And when you graduate as a senior, then you look back and you see how that portfolio performed. Because I think we all did that kind of like you pick your stocks in your economics class, and a week later you see how they did. Big deal.
A month from now, we'll see which stock has done the best.
And I think that what this does is this certainly encourages that longer term thinking, longer time horizon. And so I think that for Sam there, I mean, I think first and foremost, getting in there and just talking about the companies that his brother might be interested in is a great way to go about it. It might. I don't know that it's. We can definitely talk stocks. I mean, if you want to hit us up, I mean, give us some ideas of what you're thinking about it, and I'm more than happy to give you some opinions on them. But yeah, I mean, I think that the idea that these are untouchable. Get in with what you're interested in, because he's going to go to college and he's probably not going to even really think about it. And then 4 years later, you look and you see this and you say, "Wow, look!" And I think that's the most powerful. That's the most powerful tool right there is seeing the results. And that's one reason why I got my girls started so young, is because when they're 22, I want them to see what 15 years has done to just a little bit of money that they've contributed here and there.
One tip I will give to Sam, and really for anyone, if you're looking to get someone in your life interested in investing, it's been my experience that the easier the business is to understand, beyond just sort of, hey, I like sports, and so therefore Nike, Under Armour, et cetera, those are stocks to consider. The easier the business is to understand, the easier it is to understand how a company makes their money and how they will make more money in the future, then the easier it is for someone to make that connection.
Yeah.
Because I've owned stocks in the past that have very simple business models. Maybe the easiest one being Starbucks. Mm-hmm. I've also owned I've owned biotechs that I think I understand, and then later I look at the earnings results and I realize I don't know what they do really. And so finding businesses that are really easy to connect the dots on how they make their money, how they're going to make more money.
Yeah, I think that, you just hit the nail on the head there. You look at things like biotechs, and I think that's an interesting sector because it can be so volatile, but you have to look at those. Most of those...
And if you've got a scientific mind and that's something you're interested in, perfect.
Precisely.
Have at it.
If you know it, that's great. But if you can explain it, that's wonderful. I tend to shy away from that industry because, number one, I don't have really any insight into it. I don't know it. And to me, those are very binary sort of outcomes. Either a drug is approved or it's not. And if it's not, it can sometimes be fatal. But I couldn't agree with you more there in finding a company, just understand how it makes its money. And it doesn't have to be complicated to be good. I say this all the time. Investing is as easy or as difficult as you choose to make it. So just choose to make it easy. One of the best performing stocks in my portfolio is Chipotle. That is not difficult to comprehend. They make burritos, and they make really good burritos, and we like them, and we go back for more. And so when you find those kinds of models, Starbucks is another good one that just generate repeat sales, and they have an opportunity to grow and add more restaurants. And so, I think, that's a great way to go. And then also making sure that you give yourself some diversity. So if you like sports, you might not want to go load up your portfolio with Under Armour, Nike, Dick's Sporting Goods, and Adidas, and Callaway Golf, and all those. Probably pick one or two of the ones that you feel like are the winners out there, and then also just be aware that some are better than others. Just because you like a company's product doesn't necessarily make it a good investment decision. Look back at Krispy Kreme donuts. I think is a good example of one that everybody loves. Those glazed donuts, but man, what a mess of a stock, that's really had some tough times. But make sure that you give yourself some diversification there. And I think that one way to do that, one way that we encourage people who are going to be more sort of passive investors and just keep on investing, is to maybe if you want to add individual stocks, go ahead and match dollar for dollar those individual stocks with an index fund that covers the S&P 500, because that will give you exposure to all of those companies in the S&P. It will give you that instant diversity, and it will help. It will help in the volatility side of things too. So if you have, you pick a dud. We all do it. Not every story works. You have some diversity there that will protect you from any bad decisions that you may make. But I think that's a great idea, and just you're a wonderful brother for doing that.
Last thing I'll say before we wrap up is, and I don't want to get all mystical or anything, but be aware that for people who are new to investing, this is something that takes more energy on their part, more mental energy, and therefore eventually more physical energy. And so you don't want to overwhelm them. I actually thought of this the other day. I was talking with my my 12-year-old, and we were talking about investing, and I basically capped. She's 12, so I just capped the conversation at 3 minutes because I just thought I just want her to take away this one thing, and that's all. And we're not I would love to talk for 30 minutes, but I know that it's going to be very quickly that she's just going to tune me out, and ultimately you want people to learn, but you also want to sort of keep whetting their appetite so that they're coming back for more.
Yeah, I could sit there and talk about it all day long, and I also recognize the fact that not everybody wants to. And so when I talk with my girls about it, it's just a quick hit at dinner time or on the way to or from school, and it's not every day. It's just sort of organically, just kind of happens. I mean, earnings season kind of stokes some of those discussions, which is nice. But yeah, I mean, it's difficult. It's kind of like having kids, You can sit there and talk till you're blue in the face about the power of it, but until you experience it, until someone experiences it, they really can't understand what you're saying, right?
Right.
I mean, it's one of those things and so I think that's why you have to just figure out a way to introduce some early success, get a quick win, because it is really exciting to buy, shares of a good or a great business and watch your money grow. And I talk a lot about one of the things Warren Buffett always mentions. I think it's just great. He talks about being a net buyer of stocks, and really that's all we're trying to do is just if you have interests in collecting things, or whatever, stamp collector or whatever, you look at your portfolio kind of the same way. You're just kind of collecting shares of these businesses as you go along through life. You're just building out this little collection. It doesn't take up any space. It's all right there on the internet for you to look at whenever you want, and you're just kind of building out this portfolio over time, this collection of businesses that you like and admire, and you're just kind of growing that little diverse collection as you go along. And I mean, years later, I mean, you're buying stocks more than you're selling them, and that's what really helps you grow that wealth. And I think that periodically you check in, and then I think really once you hit the point where you wake up to the headlines that the market is just tanking and you're actually excited, that's when you know you're there. That's when you've hit the point. You are there and you are in it to win it now, because that's when as a net buyer, there are opportunities abound, and you want to have some money to go in there and buy up some of your favorite companies.
Because there are overreactions.
Yeah, they are. They're generally overreactions. Not all the time, but very often they are. And in earnings season, we see a lot of those overreactions. If they're companies that you're following, or if they're companies that we're following and you're following us, very often we will tell members to take advantage of those overreactions.
Thanks for being here, man.
You got it. Thanks for having me.
As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That does it for this edition of Market Foolery. The show is mixed by Heather Horton. I'm Chris Hill. Thanks for listening. We'll see you tomorrow.